Decoded.
Welcome to Book Decoded.
We're going to crack the code of a book, huh?
Exactly. We're going to break down a book that I think could really change the way we think about investing. It's called Rethinking Investing, a very short guide to very long-term investing, and it's by Charles Ellis.
Okay, color me intrigued. Long-term investing, always a good topic.
Right, especially with all the ups and downs the market's been throwing at us lately.
No kidding. So what's the big takeaway? What's Ellis's secret sauce?
Okay, get this. What if I told you one of the biggest keys to investment success is doing less?
Doing less. Now that's music to my ears. I'm all for simplifying things, but how does that work? Less of what exactly?
That's what I thought too. Seems counterintuitive, right? But Ellis lays out a really compelling case. He argues that our natural instincts, our gut reactions, especially when it comes to money and the markets, well, they can lead us to make some costly mistakes.
I can see that. We get emotional, we panic, we make rash decisions.
Yeah.
Not exactly a recipe for investment success.
Absolutely. And one of the first things Ellis does is introduce this concept of power curves, which he actually calls every investor's great friend.
Power curves, huh?
Yeah. Basically, it's a visual way of showing how time and compounding work together to really build wealth.
Oh, I like visuals. I'm a visual learner for sure.
Me too, honestly. The power curve basically shows that the longer your investments have to grow, the steeper that curve gets.
Yeah.
And that's all thanks to the magic of compounding.
Compounding, the snowball effect. I mean, it's a simple concept, but it's amazing how many people just don't quite grasp its power.
Right. You start small, but over time, it can really snowball into something significant. And to illustrate this, Ellis tells this great story about an emperor and a wise man. Have you heard this one?
Rings a bell. Remind me.
Okay, so the wise man, he asks for a seemingly tiny reward from the emperor. Just 1 grain of wheat on the first square of a chessboard.
Okay. Seems modest enough.
Right. But here's the catch. He asks for the number of grains to be doubled on each subsequent square.
Ah, now I remember. It's that classic chessboard problem. Start small, but those numbers get huge fast.
Exactly. By the end, you're talking about an astronomical number of grains. And that's the power of compounding at play. Those early years, even with small amounts invested, are super important because they lay the foundation for that exponential growth later on.
It's a fantastic analogy. Really drives home the point of long-term investing and how those early contributions can really snowball over time.
Totally. And speaking of compounding, Ellis also highlights this thing called the Rule of 72. It's a super handy way to estimate how long it takes for your money to double at a given interest rate.
The Rule of 72. I've heard of that, but I always forget how it works.
Oh, it's super simple. You just divide 72 by the interest rate. So let's say your investment is growing at, 8% per year.
8% sounds good to me.
Right. So you divide 72 by 8 and you get 9. That means it'll take roughly 9 years for your money to double at that rate.
Ah, got it. So if you can snag an 8% return, your money doubles about every 9 years. Now imagine that playing out over like 30, 40 years of investing. The potential is huge.
It really is. And that brings us to one of Ellis's big points. Saving. He's a huge advocate for saving as much as you can, as early as you can, to really maximize those compounding benefits.
Makes perfect sense. The more you save, the more you've got working for you, thanks to that compounding effect we were just talking about.
Exactly. And you know what? Ellis even reframes the way we think about saving. Instead of seeing it as deprivation, like we're missing out on something, he wants us to think of it as unlocking future choices and experiences.
I love that perspective. It's not about denying yourself today. It's about investing in your future freedom and happiness, too.
Right. And he actually offers some super practical saving tips in the book. Like, if your employer offers a 401k match, for example, take full advantage of that. It's basically free money.
Free money? Who doesn't love free money? Sign me up. So what other tips does he have up his sleeve?
He also suggests setting up automatic deductions from your paycheck. That way you're saving consistently without even having to think about it.
Oh, I'm a big fan of that. Automate everything. Out of sight, out of mind. It's one of the simplest but most effective ways to save.
Totally agree. And he also talks about being smart about those big purchases. Like maybe consider buying a pre-owned car instead of a brand new one. Or maybe even opting for a smaller home to free up some cash for investing.
Those are great points. It's all about making choices that align with your long-term financial goals. But it's not just about saving, right? What does Ellis say about actually investing in today's market?
That's a great question, and that's where things get really interesting. Ellis argues that the stock market has changed dramatically in recent decades. He says it's become much, much harder for the average investor to consistently beat the market.
Oh, really? Why is that? I'm curious to hear more.
Well, one of the big shifts he talks about is the rise of these institutional investors. The big players like pension funds, endowments, hedge funds, all managing massive, massive amounts of money.
Right. So it's not just individual investors anymore, just, kind of dabbling in the market.
Nope. Now you're up against these pros who do this for a living. They have access to sophisticated research, cutting-edge technology, and entire teams of analysts. Tough to compete with that.
Yeah, no kidding. It's like bringing a knife to a gunfight. So what else has changed?
Another thing Ellis mentions is Regulation FD. It was implemented back in 2000.
Regulation FD. I'm not familiar with that one.
It basically leveled the playing field by preventing companies from selectively disclosing information to favored investors.
So no more insider trading tips.
Not legally, no.
Yeah.
For Regulation FD, some investors had an advantage because they could get inside info. Now it's illegal.
Makes sense. Got to keep things fair and transparent.
Exactly. And on top of all that, the sheer volume of trading and how interconnected global markets are now, well, it's just made everything so much more complex.
So it sounds like what you're saying is the market has become super efficient, making it almost impossible to find an edge.
Pretty much. And that's where Ellis introduces what he calls one of the greatest gifts for investors today: index funds and ETFs.
Index funds. The bread and butter of passive investing, right?
Mhm.
Can you break it down for anyone who might not be familiar?
Sure. So an index fund is basically a basket of stocks that tracks a specific market index, like, say, the S&P 500.
Okay, got it.
So instead of trying to pick individual stocks, you're basically buying a slice of the whole market.
So you're not trying to beat the market, you're just riding the wave.
Exactly. You're betting on the overall growth of the market.
Sounds pretty simple. And I'm guessing there are some perks to this approach.
Oh, tons. First of all, the fees are usually way lower compared to actively managed funds. We're talking as low as 0.05%.
Lower fees, always a good thing. More money in your pocket. What else?
They're also super tax efficient because there's not a lot of buying and selling going on.
I see. Less turnover, less taxable events. Smart.
And honestly, maybe the most important thing is they offer simplicity and peace of mind. You don't have to stress about picking the right stocks or timing the market just right.
Makes sense. But, it almost sounds too good to be true. Is there data to back this up?
Oh yeah, mountains of data. Ellis actually cites data from S&P Dow Jones Indices, or SBVA. It shows that less than 15% of active managers beat the market over a 20-year period.
15%? Wow, that's pretty low. So the odds of picking an active manager who's going to consistently outperform are, slim to none.
Basically, yeah. It's like winning the lottery.
So if indexing is so effective, why do you think so many people still cling to active management?
I think it's a few things. We're constantly bombarded with stories about these star managers who do outperform.
What?
Right?
Yeah, those make headlines.
Right. But we only hear about the winners. We don't hear about all the others who fail.
The survivorship bias, right. We only see the success stories, so we think it's easier than it really is.
Exactly. Plus, I think there's this human desire to believe we can outsmart the market, that we can find that hidden gem no one else sees.
The illusion of control. We like to think we're smarter than everyone else.
Exactly. And Ellis dives into this even deeper by exploring behavioral economics, how our brains are actually wired to make certain mistakes when it comes to investing.
Fascinating stuff. Like our brains are working against us.
Sometimes, yeah. Ellis draws a lot from the work of Daniel Kahneman, the Nobel Prize winner who wrote Thinking Fast and Slow.
Oh, yeah. Great book.
So Ellis talks about some of the key biases Kahneman highlights. Things like loss aversion.
Loss aversion.
Yeah, it's like when the pain of a loss feels way stronger than the pleasure of an equal gain.
Got it. Makes sense.
And that can make us do impulsive things, like selling investments when the market dips when we should really be holding on.
Yeah, we panic and make things worse.
Then there's confirmation bias, when we seek out info that confirms what we already believe, even if it's wrong.
So we're not really seeing things objectively.
Nope. And then there's recency bias. This is when we give too much weight to recent events, even if they don't represent the bigger picture.
So if the market's been doing well, we assume it'll just keep going up.
Exactly. And Ellis uses this really striking example in the book about missing the market's best days.
Okay, tell me about that.
It says that if you had missed just the 10 best trading days in the market over a 26-year period, your returns would have been cut by almost 20%.
Wow, that's huge.
It is. It really shows how trying to time the market is usually a losing game.
Because you never know when those best days are going to be.
Right. You might get lucky once or twice, but over time, it's nearly impossible to consistently get it right.
It sounds like Ellis is advocating for a more disciplined, patient approach to investing, one that's based on understanding the market's long-term nature and that power of compounding we talked about earlier.
Absolutely. Don't freak out over those short-term blips. Stick to your plan, ride out the waves, and let compounding work its magic. So we've covered a lot: the power of compounding, the importance of saving, and the challenges of beating the market. But Ellis also offers some pretty interesting insights on retirement planning.
Oh, yeah. That's a whole other can of worms, isn't it? Retirement planning.
It is, and Ellis challenges some of the conventional thinking in this area, especially when it comes to asset allocation and income generation. I'm really curious to hear his take on that.
Yeah, I'm all ears. Retirement planning. It can be so overwhelming with all the, conflicting advice out there.
I know, right? But Ellis has a really interesting approach. He starts with this idea of the total financial portfolio.
Total financial portfolio. Sounds pretty comprehensive.
It is. It's basically looking at your entire financial picture, not just your investments, like your stocks and bonds.
So it's more than just what's in our brokerage accounts.
It includes things like your home equity, the value of any future Social Security benefits, potential inheritances, even future savings you'll get from your earnings.
So it's like a big picture view of all your financial assets, everything you have now and everything you might have down the road.
Right. And what's cool is when you look at your total financial portfolio, you might realize that you actually need less exposure to bonds than you thought.
That's interesting. Why is that?
Well, because you already have a certain level of stability built into your overall financial picture.
I see. It's like you've already got some built-in diversification.
And that frees up more of your portfolio to be invested in equities, where you have the potential for those higher returns over the long run.
So you can be a little more aggressive with your investments since you've got that safety net.
But what about income and retirement? A lot of people rely on those bonds for that steady income stream.
Right. That's the big question, isn't it? How do you make sure your money lasts?
Well, Ellis has an alternative approach. He calls it the spending rule. Instead of depending on bonds for income, he suggests averaging your portfolio value over several years. And then each year you withdraw a fixed percentage, like maybe 4 or 5% of that average.
So you're basically creating your own personal pension, but one that's based on your whole portfolio, not just bonds.
Right. And this lets your portfolio stay invested, giving it a chance to keep growing over time.
I like that. It's balancing income needs with the potential for those long-term gains.
And speaking of retirement income, Ellis has some really interesting thoughts on Social Security. He's a big fan of delaying those benefits for as long as you can.
Oh yeah, delaying Social Security. I've heard that can be a smart move, but why exactly?
For every year you wait past your full retirement age, your monthly benefit goes up by 8%.
8% per year. That's a pretty hefty return.
It is. And those increased benefits keep coming for the rest of your life, and they get adjusted for inflation. So your income will keep pace with those rising costs.
That makes a lot of sense. Delaying Social Security lets you maximize your benefits and gives your investments more time to grow. It's a win-win.
It really is. So all these strategies, understanding your total financial portfolio, using the spending rule, delaying Social Security, they all come back to those core ideas in rethinking investing, thinking long-term, saving consistently, and making smart decisions.
It's about taking control of your financial future and making choices that, really fit your goals and values.
Absolutely. And I think what's so valuable about Ellis's book is that he gives people the tools and knowledge to do that. It helps them make informed decisions and, shift their focus away from trying to beat the market and toward playing that long game.
It's recognizing that investing is a marathon, not a sprint. And you need patience, consistency, and a good plan.
So true. So for all our listeners out there, I want to leave you with this thought. What if, instead of stressing over every little market move, we focused on building that solid financial foundation, saving regularly, and investing for the long haul? What if we embrace that power of compounding and let time work its magic? To me, that's what rethinking investing is all about. Thanks for joining us for another deep dive.
It's been a pleasure, as always. Happy investing, everyone.